Our accounting world is still spinning, so we must be looking after it and increasing our accounting knowledge. What we're going to be doing today is we're going to be looking at the principles, concepts and principles which govern accounting. So if we were at the beach, there would be certain rules: do not litter and conserve, obviously to be fair and considerate to all those who use the same place and space. Now, it's not too different in accounting. There are going to be certain principles and rules that need to be followed, and this helps all your numbers to be reported in a fair and consistent way for those people who are going to use your financial information, all the stakeholders in the business. In this video, I'm going to discuss those principles that look after honest and fair reporting. There we go. Following the principles will result in fair, accurate, and consistent reporting for all stakeholders. And as you can see, there's always some nice scenery at the sea, so enjoy the refreshing Indian Ocean along the way. This is what we're going to cover. We're going to cover the principles of accounting, some principles, and the IFRS international framework, qualitative characteristics. We will cover that as well. So we're going to look at prudence, materiality, the principle of historical cost, the business entity rule, the going concern rule, and the matching principle, as well as some characteristics that have been put in place by international framework, which will ensure better reporting, fair, consistent, honest reporting. Before we move on, I just want to explain that what a concept is. An accounting concept, we're looking at the ideas and assumptions that are made when it comes to accounting. Now, a typical idea or assumption, if you start up a business, the business will continue. Okay, so we're looking at an idea. You start up a business, you're not thinking the business is going to go into liquidation. We're going to record information, financial information, as the business will keep going. We assume that the business will keep going. Now, a principle which governs that idea is the going concern rule. So that gives you a better understanding of the difference between a concept and a principle. So in this second pop-up here, accounting principles are the rules that guide accounting concepts. As I've just explained, when you start up a business, you assume or have the idea that it will continue, and then what has happened, the principle of the going concern principle, will guide how financial information is recorded, assuming that the business will continue. So hopefully I've made it a little bit clearer what the difference between a concept and a principle is. A concept is the assumption or idea, and a principle is the rule that guides how information is recorded. So we throw the dice and we've rolled a 3. So we're getting off to a nice easy start as we move on to the principles. Wow, that's quite a big fish. Now the reason I've put up pictures of fish here is I want to introduce the principle of prudence. Now if I took this fish and I straightened my arms, the fish would be closer to the camera and the size of the fish would be exaggerated. So I would be exaggerating the size of the fish. Most fishermen do that. They make out their fish is bigger than what it is. But should we be doing that in accounting? Let's have a look what the prudence principle says. The principle of practicing prudence means that the accountant or the bookkeeper must take the conservative approach. So an example of this would be not to overstate or exaggerate the value of the assets of the business. So what prudence is about is taking the conservative approach, not like a fisherman who tends to exaggerate. There we go. That fish is looking much bigger than what it actually is when I zoomed in. Now, prudence must fairly represent, it enables the bookkeeper to fairly represent or estimate the numbers in the books. And in order to fairly represent the numbers, income and assets should not be overstated, exaggerated. Expenses and liabilities should not be understated. If the numbers aren't represented accurately, the financial position and the financial results can be very misleading. So the principle of prudence is saying take the conservative approach when recording transactions. Caleb came to me this morning and he asked me if I could put his painting in a video. So there it is, the painting of the seahorse. Now, taking into account the prudence principle, which said that income and assets should not be overstated. Now, if income, let's say for example, sales was overstated, we would have here income overstated minus expenses, and that gives us a profit if the income is greater than the expenses. Now, if the sales figure was overstated and then income would be greater, the profit would be exaggerated. So by overstating income and assets, a completely different picture could be painted of the financial result. By the way, this is a trial balance of Calibu Education. More about trial balances in another video, but I just want to demonstrate if there's an exaggeration of figures, how your profit and your position of the business can be misleading. So it's important to take the conservative approach. If expenses and liabilities, they should not be understated, So if that expense there, all your expenses, telephone, wages, rates, etc., somewhere along the line they were understated, you're going to have a bigger profit than what you should have. So adjustments are done at the end of the financial year, but more about that a little bit later. But I think you get the idea. Let me just do this last demonstration. The owner is worth the value of the assets less the liabilities. Now, if the assets were overstated, then the books would show that the owner is worth much more. So it's very important to fairly represent the numbers. All these principles are geared to fair representation of the numbers, but the Prudence one, which I'm still busy on, says you must be conservative in recording all the financial information. So hopefully that demonstrates the principle of prudence just a little bit in more depth. So income and assets should not be overstated. Expenses and liabilities should not be understated, because once again, if liabilities were understated, it would make the owner worth so much more. It would be misleading. So this little demonstration just gives you more insight into the importance of the prudence principle. The question is, do material things matter? Yes, they do in accounting. So the principle of materiality is in place, and let's see why. So the principle of materiality, I struggle with that pronunciation, states that all information that is needed by stakeholders, owners, people who use the financial information, items of materiality need to be included because it will affect how decisions are made, how decisions by management are made, how decisions of the stakeholders are made. So if something, an item, is of significant value in the context of the business, it needs to be recorded separately in reporting, let's say, in the statement of financial position. Items with significant value in the context of the business need to be recorded. So there we go. Items that will influence economic decisions can't be left out of the financial records. So material items matter in accounting. I will try and explain the principle of materiality a little bit better here. Let's have a look at equipment. So the equipment for Calibre education could be computers, printers, those type of items. Now we see that Calibre education has spent 17,274 on this type of asset. Now if there was an item which was categorized as equipment for 300 Rand, that is a small amount, and you can see it is of insignificant value in the context of Calibre education. So it's not shown separately. But if it was a big item, it would be definitely needed to be shown separately, as it might affect the decisions that I make. So if something is of significant value within the context of the business, it needs to be shown because it might affect my forward planning about how much I need to spend on my equipment, for example, or what I need to spend on vehicles. So once again, if something is of significant value, it needs to be shown. I've just put something here. If you apply your accounting principles, you're most probably going to go to bed sleeping well because you've done it fairly and honestly. It won't keep you up at night. It's always nice to have a little laugh. This year, on this slide, we're looking at the principle of recording items at their historical cost price. So let's say this vehicle here belonged to Qualitative Education. The vehicle will be recorded at its original cost price. So in the vehicle's account will be the value after if input VAT was accounted for. So it's the price excluding VAT, which is the historical cost price. That will be recorded on the books, in the books of Qualitative Education, the original cost price excluding tax. So in this example, on this trial balance, there's 152,522. That is the original cost price of the vehicle. So there's an example. The trading inventory, 37,398.96. That is the original cost price of the stock that was purchased. So the historical cost principle states that items need to be recorded at their original cost price in their accounts. Purchases are recorded at the original cost price, exclusive of VAT, if VAT is applied in your country. This year is Qualitative Education. Remember, we're doing the books of Qualitative Education in most of my videos, well, in all my videos. I'm the owner. This is my house. Now, the business entity rule states that the business's transactions and the owner's transactions are recorded separately. The owner and the business are two separate entities. The business entity rule states that the owner's personal transactions are separate from those of the business. Here we can see the owner has purchased some healthy fruit. That is the owner's transaction made in my personal capacity. When we are recording information, the business entity rule also says all transactions are recorded from the point of view of the business. So all purchases made by the business for the business to operate are recorded in the books of the enterprises. And I mentioned earlier, records are kept looking at transactions from the enterprise's point of view. So the transactions of the owner and the business are recorded separately. In the next slide, I will show you separate accounts that are opened in the books of the business for the owner, capital and drawings. I'll show you on a trial balance in a moment. As you can see, here is the trial balance of Qualitative Education, and as I mentioned, there is a capital account for what the owner puts into the business, and also the business profits at year end will also be closed off to the capital account. But this 210,000 is what Qualitative Education owes the owner, less drawings, what the owner has taken out. So capital is what the owner put into the business plus the profits made for the year, or less the loss made for the year, less drawings. And that is what is owed to the owner. So those are the only two accounts that relate to the owner, and they're shown separately here in the books. That purchase of fruit on the previous slide is not a transaction which relates to the business, so it's not recorded in the books of Qualitative Education. What happens is Qualitative Education will pay a salary to the owner because the owner works at the business, and the owner will purchase that fruit, well, in my own capacity. Only transactions that occur in the operations of the business will appear in the books of the business. The business entity principle states that the business and the owner are two separate entities, and they're recorded as such. The going concern principle states that, or it is a rule, a concept, an idea, that all financial transactions will be recorded as if the business will continue. So there's a perpetual existence of a business. So Qualitative Education, when the bookkeeper or accountant is recording transactions, the business is treated, all numbers are seen as if the business is going to continue, and the business is not going into liquidation. For example, or what liquidation means is the current assets don't cover the current liabilities, then you can go into liquidation. Remember, I'm looking at a sole proprietor, so there could be serious consequences for the owner if the business had to go into liquidation. But the going concern principle states that all transactions occur as if the business will continue. All assets are valued as if the business will continue. So you can still obtain loans, etc. But more about that, you can get credit from a supplier. If the supplier sees you as a going concern, you will definitely never get credit if the supplier saw you as a business that is going into liquidation. So the business and all transactions, like I've mentioned, are treated as if the business will continue indefinitely, forever. The numbers here on this trial balance of Calibre Education record all the values as if the business was going to carry on. So the going concern principle has been applied. If Calibre Education went into liquidation, these values here, say for example for the vehicle or equipment, trading inventory, those are assets. The values would be seen very differently. They might be valued, those assets, according to what they would receive at an auction. So this year, if the business was going into liquidation, these numbers would change dramatically. You wouldn't be able to get credit from suppliers. You wouldn't be able to get a loan. So the liabilities would be seen very differently. The asset goodwill, it's not on this trial balance here, but basically your reputation as a business would have no value. Goodwill, normally an asset to the business, would end up being zero. These expenses here might change. Things would be viewed very differently. But the going concern principle states that the business and the amounts of the items are recorded as if the business will continue. The matching principle states that all income earned and all expenses incurred need to be recorded in the correct period. So in your financial year, you need to have recorded all the income earned in those 12 months, and you also need to match the expenses that were incurred in earning that income in the 12 months. Now this is quite important because you want to show the correct financial result for the year, which is whether you made a profit or a loss, and income less expenses will either be a profit or a loss. So the matching principle says you must show all your income earned in the 12 months we're looking at, the financial year, and you must show all the expenses incurred in the 12 months, the same 12 months. So you will be able to accurately present your financial result, the profit or loss. So sometimes there would be adjustments that need to be made at the end of the financial year. Say for example, prepaid expenses, accrued income, owing income, but we will get to adjustments in a later video. Matching principle, all income and expenses that are incurred or earned in the 12 months that we are reporting on need to be accurately represented. These are the nominal accounts in the books of Calibre Education. This is just an extract from a trial balance, and here you have income and all your expenses, and if you said income less the expenses, you would get the profit or loss. So the matching principle, let me give you an example. These sales took place and the total of the sales was 159,972 and 9 cents. But in making those sales, there were costs involved, and the costs need to be shown in the exact same period as the income, the sales. So income and expenses are matched in the same period. And I mentioned previously, so we're going to show the honest profit or loss by including all the income and the expenses for the financial year in the books. So there we go. The matching principle matches income and expenses that took place for the period. I thought I would include these qualitative characteristics. The IFRS, International Financial Reporting Standards, try to control the quality of financial records by putting in place fundamental qualitative characteristics and 2, enhancing qualitative characteristics. So the IFRS is trying to maintain standards and quality control of financial information. So the fundamental qualitative characteristics are relevance and faithful representation. So all information that is relevant for stakeholders to make decisions, any information that influences the decision making of stakeholders needs to be included. For example, an item of value. That is the materiality principle. It is relevant if an item is of significant value and it influences the decisions of stakeholders. All information must be honest and accurate. So there's faithful representation. Then there are also enhancing qualitative characteristics, comparability, understandability, timeliness, and verifiability. Now, comparability means the financial records must be able to compare last year's records with this year's records. So reporting needs to be consistent. Then also you need to be able to compare your books with other businesses in your industry. So policies need to be reported on, and policy needs to be consistent. All the information needs to be understandable to stakeholders, with those people that have a bit of knowledge, economic and accounting knowledge. The information needs to be clear and understood. The timeliness of the information is very important. So if decisions need to be made, information that helps those decisions being made need to be in the correct period. So in the correct financial year, transactions need to be recorded at the right time. And the last enhancing qualitative characteristic I'm going to cover in this video is that of verifiability. Now what that means is, if another auditor goes and does the books, they should come to the same results as the initial auditor. So the second auditor will verify what the first auditor recorded, or the results and position that the first auditor reached. Those results and position of the business should be verified by another auditor. So the books were recorded in such a way that the same results and positions can be verified by another auditor. So there we go. The IFRS has put some qualitative characteristics in place, fundamental qualitative characteristics and enhancing qualitative characteristics. This could be a short question, so know it. It's important, but the IFRS is trying to just keep control of the quality of the financial information that is being reported. And just to recap on the qualitative characteristics, all these numbers here in Calibu Education, they should be relevant, honestly and accurately recorded. Same policies should have been used in able to compare previous years with the current year and with industry norms. All this information should be clear and easily understood. All the information in the books here in this trial balance should be in the right correct period, and if someone else went and did the books, they should get the same results as the first person who did the books. So there we go. I hope you enjoyed that video and you're an accountant of principle. If you're going along the beach, life, carve your name there in the driftwood. So thank you very much for watching. I hope you've been empowered and you know a little bit more about the accounting principles and the IFRS qualitative characteristics. All these principles and characteristics ensure good, fair, honest financial reporting. That's why they're in place.